Testing 1 2 3, testing 1 2 3. So, hello, and a massive hello to everybody. Hope everybody's having a great day wherever you are, whatever you may be doing. 50 pips, rocking and rolling, 23rd of Jan. So let's do this. No trade calls, no recommendations. Everybody responsible on stuff. We're here for educational purpose only. Just having a chat. So again, as usual, I committed to doing these once a month live streams just to shoot the breeze and go through any charts. There's no real plan. There's no real schedule. So more than happy to review any chart anybody wants to look at, discuss anything anybody wants to discuss. And we'll try, we can stay on as long as people are around and people have questions. Try to keep it under 1 hour, ideally. So, hey, Vic, how's it going? What's going on? So if anybody has anything they want to discuss, just ask, don't be shy. And if not, I'll go through a couple of charts. Then if there's no questions, I'll shut it down. If there's questions, we'll keep on going. So where are we? Well, interesting week ahead. China's on holiday, so the overnight sessions could be a little bit slow. We've got a blackout period for the FOMC members going into next week with the Fed decision. It seems that they pretty much leaked. It's a lock, February 25, March. We'll have to see if anything changes. What's interesting this week is that we do have GDP and a core PCE. So, we'll have to see what happens in case we get some kind of surprise there. And again, the focus is going to be on continued earnings. And we've got Microsoft, we've got Tesla this week. So it should be interesting. A lot of people here seem to be hellbent on trying to pick the next rally into all-time highs, ES back into 5,000, or trying to get ES down to 3,000 and everybody's going to die. Right here, one thing which we've been discussing is don't forget that, markets can always do three things, right? They can go up, they can go down, but they can also go sideways. And I think that's something which everybody needs to keep in mind. And don't be surprised if we say in a broader choppy trading range. And again, as traders, I think we discussed it here last time, but if we stay in a well-defined wide enough range, that would be awesome. That would be great. A lot less risk, much easier to trade. Just not ideal for people who have a bias or who desperately want to see some outcome. But for traders, that would be fairly pure. Here, what we've been discussing in terms of the action on the ES and what I would be focusing on again is that, the moving averages, especially like the 200, a lot of people speaking about the 200. Once these moving averages have been violated many, many times and they start flattening, they're far less interesting. It's really defeats the purpose of moving averages, right? Once we're going sideways. So what I would focus on here is horizontal levels rather than the moving averages. Also, a lot of people have been focused on this descending trend line on the ES with this false break and the 200 DMA. But, equally, you could be focusing on the fact that the market is trying to coil higher. I really wouldn't pay too much attention to this. I think we're in a choppy area. We need a strong catalyst. There's thin liquidity in the middle of this range simply because if you're structurally bearish, there's no real reason for you to change your view. And if you're structurally bullish looking for the turn, there's really no reason to change your view. So what it means is that likely, the stops or the point at which people are going to give up is much higher or much lower. So what that creates is a lot of velocity of move inside this broader range. That doesn't necessarily mean anything, right? So what I think is I would be focusing on is, does the market manage to trade with a day close, weekly close above the 4,200? Or does the market manage to trade with a day close, weekly close below the 3,700? Now, if either of those occur, you can make a very, very good case and you would expect to see an explosive squeeze higher, possibly back into that 4,800 and those highs. And if we take out that 3,700 from a day close, weekly close, you would expect, potentially in a day, extremely quick attempt to try and test the 3,500. And then, that's going to be the line in the sand. But as long as we're here, I continue to see unless there's a big change in terms of something coming out in earnings, in terms of the Fed or something, you'd really want to be looking to fade any failures into this area or fade any failures into this area and expect the market to continue to chop around in this broader range until something substantial changes. So right now, a lot of people are trying to make something out of what happened on Friday. To me, the overall action is not extremely bullish. The market seems fragile, and we were looking more for playing the short side last week, and I just put Friday down to usual OPEX shenanigans. Usually, I'd like to remember people who don't focus it so much. One of the best trades or the locks is to trade a Momo grind higher, a Momo grind lower, to try and stab or pin around a round number for OPEX. But I wouldn't read too much into that. Really, this week has nothing to do with what we saw on Friday. This week is going to have everything to do with what we get out of Microsoft and Tesla, but especially, does the GDP number and the PCE number clarify or give us any more clarity into, are we going to stick with this Fed being a lock 25, February, March, or is there going to be a reason to change? Remember that, the Fed keeps on talking asset prices lower, rates higher, 5% plus. And they've told us, unless we have consecutive month-to-month, back-to-back month with weaker data, they're not going to even think about reviewing their thought process or what they're trying to do. So right here, it's really hard to be extremely bullish or extremely bearish, in my opinion. It still favors that range trade, right? And again, it's been a beautiful trading because, as I said, these ranges are fairly interesting. Now, the other thing which I think is a lot of people are talking about is crude. We discussed this I think even in the last live update, is it's very hard for us to be structurally bearish crude, and especially when you've essentially got a bid into those 70s, and the way this is trading, we were looking for a short-term low and a rotation back higher, and what we wanted to see was the market to come back above this breakdown zone, and this has been very nice action. You see making a series of higher lows, getting back above, popping back above the 10-day and not looking back. Here, I think the level to watch, the number to watch continues to be the 80 mark. And as long as we trade above the 80 mark, here the risk is for this to continue to squeeze back into that 90. You're going to have the 200 coming in, not that interesting to me simply because it's starting to flatten up. But that and then 90 will open up test of a higher of 100 and higher. Now keep in mind, if you see with this whole China reopening story, if you see crude starting to go, as we like to say, cocaine angel to the upside, you see copper holding a good bid, you see a lot of the commodities catching a bid again, that's not going to bode well for inflation. So I wouldn't necessarily be buying bonds with both fists, right? So that's what we're looking at here in crude. And again, I still think that it's going to be very hard to be structurally bearish here, because likely any hit and run we may see all the way back into this breakup zone, this will likely be supported. You'll likely still have buying here. So I think any move back towards the 80 is still probably a buy opportunity, unless we get closes below this level for that rotation back into the 90, right? Gecko 2020, welcome. Can you please look at Euro USD? Sure, we can look at Euro USD. Do you have a specific question on Euro USD? I'll just refresh our play on Euro USD. Basically, since the last couple of ECB meetings, our base case was the only thing you could do is be long Euro and short Bund. Long Euro, our trade was on a move back above the parity mark, which is a pivotal mark, move back into 105 and 110. So pretty much this trade for me in terms of the swing trade is pretty much done here. And now we'll get a little bit more interesting. But here, especially the way the Fed is going and the way the ECB is going, you really wouldn't want to be structurally short this, in my opinion. But for me, the nice trade to the upside is pretty much done here, or the meat of the move is done for now. Could this come all the way back into the 105 and then extend higher? Sure. But right now, 110 is going to be a difficult nut to crack. So if you're looking at this from a weekly perspective, what you see here, and something that may be interesting for you to keep in mind, is you see this move from highs to lows, right? Let's do it this way. A to B. This is the 50 back. You see how the 110 comes into the 50 back. So you would expect to see a lot of resistance in this whole 110 into 112, 113. Let's pop a line here just for, oh no, that's not what I wanted to do. Hold on. Into the 113. So the big question here is you're going to have the bulls and the bears fighting. So basically the bears are going to say, okay, that's it. We've had a retracement rally back into 110, 113 area. This is the sell zone. And, people who don't like the euro always like to call for die euro die back below parity. So they're going to be looking at this as the sell zone for euro to come back down, for the last 10, 20 years, whatever, euro is going to die. And the shorts will be looking at this, and the bulls will be looking at, no, this is very constructive. We want to buy any dip back into the 50 back of this move from A to B, which is probably going to be around the 105, for then a continuation higher. What's interesting in this scenario I would draw your attention to is that whether you're a bull or a bear, it would make sense that in this area we pull back, right? It would make sense. It would be healthy to see this pull back maybe back into the 105. So I think here we're one of those locations where both bulls are going to be looking for shorts. Bears are going to be looking for shorts, and bulls are going to be starting to look for take profit or starting to scale out of the longs that they're likely carrying from this, as we were from the pop back above the parity mark. Does that make sense? So, that's the way I would be looking at euro. And it kind of, and you can see here, if you're going to see an explosive move or not, you can have a fairly good view by keeping an eye on DXY, right? DXY is essentially euro. And you see how DXY is back at the 50 back, and it's trying to crumble here. So what you really want to watch, and what's very, very important here at the beginning of this week, is to see how this is a 1, 2, 3, 4, 5, 6, 7, 8 day range on DXY. You want to see how we trade today, because if we flush below, this could be very, very flushy, air pockety down all the way back into the 99. And that could mean that euro catches the shorts off guard at that 50 back, and basically that ball underwater continues to squeeze back into the 61.8. If not, if it stalls, then you would expect this to bounce. Now the bounce, so if this bounces and euro comes down a little bit, it doesn't have to be the end of the world, because you see this could easily just come back into this 5, 6, 7 day range and break from there. So I think really the key, like everything, a lot of things are stuck in range, is to watch this range and see how long we continue to play around here. And especially at the end of the week, after we've had the GDP print, after we've had the PCE print, are we settling above or below this previous 5, 6 day range in DXY? That's going to be the most interesting thing for me to look at. Now, another thing which we discussed this in the last 2 live sessions, I think, long gold through the last FOMC meeting of the year for the seasonal trade into January, Feb. This trade is in play in gold. As long as this holds above the 1875, this trade is good for the 2000 mark. As usual, you do not want to overstay your welcome, especially, if you got long on this move back inside our weekly range. you're sitting on a lot of profit. And remember that risk reward is an evolving number or concept, right? So the closer you're getting to your target, the more risk you have and the less reward you have, assuming you're not trailing your stops. So you want to be a little bit careful here. But I think, what you want to look at is, again, 1875. How does this hold? As long as this holds, the rotation is still good for the move higher. If that lets go, then don't be surprised for this to come all the way back into the 1800. This has been a great run, and this could still be just a little bit of retracement for a continuation higher, right? But again, I would be very, very careful chasing this. The nice trades here were, on the break through in November, December, not trying to chase it higher here. You can go back on the weekly and you can see, we've had some monster defense and sells in this area. This is not where you start to get all bulled up, okay? What else have we got? No questions, might be a short one. So again, the other thing, which again, I think is going to be interesting to keep an eye out for, probably most people are watching ZNs, and here, this week, like the key line is pretty much those 114s. That's what you want to focus on, right? We've had this very nice and technical rotation back up into the 200. The 200 has failed here. And now what you really want to watch is how it tackles the 10-day and the 114, this big pivotal level. Again, the bulls are going to be all bulled up. Fed's going to pivot to the moon. And the bears are going to say, this is just a BS move. There's no way this is going to yields are going to go back to like 2.5 or whatever these things have to go back to 4.5, 5. If you're looking at the technicals without trying to express an opinion, the key level, I think, also psychological is this 114. Clearly, unless this can clear this series of higher lows and all this cluster of moving averages, this is still trying to hold an upside rotation higher. But keep in mind that this is very stretched. And what you want to watch out for, especially if you're playing the longs, is if we lose, the 100-day, the 50-day from a day close perspective, don't be surprised if we flush all the way back down extremely quickly. You really need to see this level hold. So again, I still think the longs are going to be trying to buy any move back down into this area. They're still looking for this to continue higher, and the bears really need to get it back below, back into the 112s pronto to try and force that unwind of this move. And likely data is going to help us see which way to go and if these moves can get some serious traction or not. Okay. Okay. Comments, questions? Looks like nobody's asking any questions. Might be a short one. Let me see if there's any interesting charts that we can talk through. A lot of people trying to call whether we're going to get a double top on cable or not. Hey, Leon, how's it going? I think it's a little bit of a messy one. Rather than the double top or not, I would prefer to focus on the horizontal level of the 123. And basically, don't worry, Leon, the recording's going to be up. But here I would really focus on the 123. But the problem is on a lot of these on FX, you've got a lot of messy zones, as we've discussed. These got these sideways ranges across the board. You've got all these moving averages all the way in the middle. They're all flattening. I think it's really, really messy. So I really don't think there's that much edge. I think, yen and euro have been the clearest trades. Everything else has been extremely messy. And really the edge and the risk reward, the actions all be on equities and bonds this year so far, unless you're holding some kind of a swing. Nat gas, what's going on Nat gas? Do you have a specific question on Nat gas? Idea, concepts, and trading, how's it going? Nat gas, I mean, just a little bit of a service, public service announcement. Nat gas is a great way for retail traders or junior traders to blow their accounts. If I can give you a little bit of boring advice, of course, everybody's going to say, go home boomer. But even though I'm not a boomer, but if you're somebody who's starting out to trade and or not super experienced, or even if even if you're experienced, trading like the softs, trading nat gas, crude, most of the commodities is a great way to blow your account, right? If anything, you have a lot more edge trading the more liquid stuff that has standardized contracts. When pit closing times are, et cetera, et cetera. Trading stuff like wheat, nat gas, cocoa, orange juice, even crude is extremely hard. You're making things much harder for yourself. Even a lot of big professional funds have blown up trading nat gas. So you're making it harder for yourself. So what's going on in nat gas? Well, here, I mean, again, preface this by saying I have zero interest in doing anything on nat gas. The only thing I will venture, I will say that, if we trade anytime, any commodity, anytime everybody starts to talk about any commodity saying that it's going to zero, then I get interested, right? But for me, the last time I did anything in nat gas was back in 2020 when we were trading close to $1.50. Right here, to me, this is not cheap enough to buy, and it's not expensive enough to sell, right? So I don't really have an opinion. If you want to talk about it chart-wise, the thing that strikes me, the first thing my eyes look at is that you've got this big support zone, right? Support resistance zone. And as long as we trade below this is likely going to continue to trade heavy, and this could easily flush all the way back to try and hit the 2 mark, right? This is what I would be. So I would be careful as long as it's holding above here. So I think here the risk is, unless we get back above the 10-day moving average, and unless we can get stabilized above these 2 horizontal levels, the risk is for a continued flush back lower. And again, remember, this could be very illiquid. And if for any reason, whether that be weather-wise, news-wise, I don't know, I'm just looking at the chart here, this can stabilize, day closes back above the 10-day moving average, back above these zones, then there could be a little bit of a potential for a little bit of a squeeze, maybe, all the way back up into this level. But that's the only thing I see here. I really wouldn't be interested in doing anything at all here. Since we're talking about stuff I don't trade or I wouldn't trade, let's look at copper, because I know a lot of people have been talking about this too. Basically, copper. We discussed this. I think mid last year when everybody started talking about China reopening, and what we said is, this is just going to trade on China. It's probably going to take a while for the whole China reopening to get traction, because it's definitely, even if it was going to happen, it wasn't going to happen before the winter. If anything, it was going to play out for after the winter into the spring. And right here, if you look at this, and actually we can go back on a monthly, you can see that this is bid. There's really no reason to be structurally bearish copper. If anything you'd want to be long. But the problem is, if you see on this chart, it's very hard to chase this higher. So, either you're a Momo monkey and you want to chase it on a break above this area, or you're hoping you get any kind of headline, anything ugly for this to flush back down so you can buy again. But here, this is again one of those levels for me where it's not, the buys or the sells are higher and the buys or the sells are lower. So it's really not that interesting to me here. And last but not least, since we're talking about stuff people get killed in, let's look at silver. And here, the only thing I want to say on silver again is that keep in mind, we're stuck in, this is still a fairly bearish configuration. I mean, if everything opens up, and all the commodities stay bid, don't forget that silver is an industrial metal. So, silver should play along with everything else. But here it's far from a super ideal place to start getting aggressively long. And keep in mind that, the strong seasonals are January, February, and then it kind of dies down a little bit. And ultimately, this is still making right here series of lower highs. So I really don't see, unless you want to be buying here, trying to have a stop below the 23, looking for this area to hold and then looking for that breakout. But, I really don't see it here. I'd be very, very careful chasing the upside here. This is like gold to me. The long was November, December, not here. Can you look at DAX? Sure. What's going on the DAX? So basically here, DAX is trying to hold an upside rotation. I mean, all these, risk in general is trading together, whether you're looking at equities, whether you're looking at Bitcoin, right? And right now we're kind of hovering, right? So what's happening, right? We're just we bought a big 50 back and it tried to rotate higher, right? Then you look at this most recent move off the lows into these highs. You got some messy action, but you see how the retracement got bought, all those moving averages supported, Luca. And then look where it stalled, right at the 123 extension. So this is being extremely, extremely technical here. So what I would say here, if you're looking at the daily, what I would focus on is basically this previous high here as a bull bear line and this previous high here. And what I would say is that, if you're structurally short, people are going to be shorting with stops above this range. If you're long, people are going to be looking for any kind of long with stops below this range. But I think here most likely, and similar to equities on the US side, this is a very choppy zone. This is a very choppy area. And what you would expect is that if we can get a day close above, then this is very likely going to extend back into those all-time highs and basically move an extension on that original fib move towards the 150, 161 extension. And if we break below, well, then there's extremely high chance that this is going to try and come back down, flush these lows and flush the 200. So to me, it's not a particularly interesting zone. I think it's a little bit trickier to play than US indices. But right here, I would say, this is the chop zone above. You have to you chase it to the upside and possibly look for shorts higher. And below, you chase it to the downside and possibly look for counter trend longs here. But right here, it's kind of very, very messy. I think the focus here is we have to see how data evolves. We have to see what earnings do. We've got the Fed coming up. We've got the ECB coming up. There's a lot of risk here. So, and you can see by this action, you can see a lot of gap ups and stuff. There's a lot of squeezy action, thin market, and ahead of a very busy data calendar, earnings calendar, right? And central bank calendar. So I think you want to be careful and not read too much into these moves that we're seeing, whether they're to the downside or the upside, unless the data confirms. Remember, the central banks have told you it's all about the data. They have to get inflation in check. And even if we start to see a little bit of cooling, they want to see 2 to 3 prints in a row, right? If not, they can't run the risk of messing it up and looking like even bigger clowns than they already look like. So chances are they're going to overshoot, right, in terms of rate hikes. So there's going to be a time to be aggressive, to play for the turn, but you want that data to confirm, because they're not going to risk looking like fools, even though they ultimately probably will. But again, you want to be a little bit careful. So a lot of it also boils down to, are you trading intraday? Are you trading with a 1 month horizon? Or are you trying to position your book for the next 1 to 2 years, right? And depending on how you're looking at that, your analysis is going to be not your analysis, but the way you start to move your funds or the trades you start to put on are going to be very, very different, right? So again, be careful about whoever you listen to, because unless you know what time horizon they're looking at, you're not comparing apples and apples. But again, if you're looking at a 1 month horizon, it's chop, because you're going to have FOMC, ECB, and you still have all the earnings to come out, right? So it's hard to believe that you're going to put on a trade right here with a tight stop and it's going to survive the next 2-3 weeks. Now, if you have a long-term view, whether that's, yearly view or bigger view, and you have to position a bigger portfolio, you can use, and actually you want to use, the chop you're likely going to see in the following 2-3 weeks to position and get into those trades. But if not, if you're a shorter term trader, here it's about trying to play the ranges, trying to play the chop, not worry too much about the narrative or the bigger picture. Okay. So, any comments, any questions, anything anybody's looking at, anything anybody wants to discuss? Happy to stay on if we have any questions. If not, we're going to call it a day. Yeah, I sent. Yeah, you should have. You should have received the weekly outlook, right? So you probably. You probably have that already. Again, just one thing which I would say is you really want to be careful here going into the this next week's, because there's going to be a lot of volatility, a lot of messy action. So just focus on price action. Don't get too upset with, don't get too focused on your bias. Gecko, we looked at the DXY earlier. You can watch it on the recording. You can catch it on the recording. So again, just keep in mind, there's a lot of risk. Bulls are going to be focused on the fact that, the market is looking for an excuse to go higher. Bulls are going to be trying to press this higher. Bulls are going to be saying the Fed's going to pivot, Fed's going to turn. Bulls are going to be saying all these layoffs we're seeing from tech are just tiny. Buy. The Bears are going to be saying, the reaction we're seeing here to these tech layoffs is the same as 2000. Market wanted to rally, but ultimately it ends badly. They're going to say, look, Fed has told you 5% or higher. It ain't going to happen. So again, you can make a fairly articulate point, both for trying to average in on long stocks, long bonds, and you can make a fairly articulate case for, this isn't over yet. We still have to probe a little bit to the downside, even if we're not necessarily going to print new lows, and that goes both from stocks and bonds. I would focus on the ranges. I would focus on the horizontal levels. I can't stress this enough. As shorter term traders, you should light a candle and pray to whoever you want or whatever you want and thank them for broad ranges. If we could stay in this, 4,100, 3,800, or even 4,200, 3,700 for the next 10 years, I mean, it would be wonderful for traders. You don't necessarily need a trending market. You can get away with a lot more in broader ranges, as long as you don't have a bias and as long as you focus on on price action. Okay, guys, we'll do it again in a month's time. Thank you so much for stopping by. All the best. Talk to you guys soon. Take care. Bye bye.